Financial Modeling, Topic 14, Futures Contracts. Topic 2, Calculating Margin Requirements, Maintenance Margin, and Margin Calls. So let's look at an S&P 500 futures contract on the Chicago Mercantile Exchange. Here's a quote I brought up from the CME website for the S&P 500 futures. And you can see for a September delivery, December delivery, March delivery, and June 2020 delivery, the quoted prices or prior prices are $29.22, and for the December, March, and June contracts, $29.18, $29.19, $29.21. You can see the open interest or volumes. Looks like most of the trading is taking place in that September, or all the volume in that day is taking place in the September contract. That contract, by the way, has a notional value of 250 times the futures price. So you can think of that as simply as a contract multiplier, or you can think of it, this contract is for the delivery of 200 S&P 500 portfolios. This contract is cash settled, meaning it's not physical delivery. You don't actually need to deliver 250 S&P portfolios. You simply have an exchange of cash based on the change in the futures price, which is driven by the changes in the underlying S&P 500 price. The settlement or the daily profit from the position is the daily change in the futures price times 250, which results in the final spot price ST minus F times 250 at the maturity plus interest for the buyer. There's an initial margin equal to the margin percent times the futures price times the multiplier. That futures price times the multiplier, that time sign is called the contract value. You earn interest on that margin balance, and think about the margin as kind of a security deposit to ensure both parties are there to take delivery and make payment. There's also a maintenance margin. Once that initial margin falls below 70 or 80% of the initial margin, you'll have to put money back in the account to get back to the initial margin. And again, there's this daily mark-to-market or settlement process. And if you are long the futures contract, your daily margin change is going to be the whatever margin you have on balance at the time times an interest rate plus the change in the futures price times the multiplier. And if you're short, it's minus the change in futures price times the multiplier. So here's an example. We go to Excel. Again, we're looking at the S&P 500 futures contract. The size of the contract is 250 times the S&P 500 index with delivery months of March, June, Sep, and Dec. And it's cash settling based on the opening price of the third Friday of the expiration month. So let's pretend we took a position in one contract, and let's say we're going to be long. We're going to be the buyer. That contract again has a multiplier of 250, and that September price had a price of $29.22. So that's the quoted price today for a September delivery of 250 portfolios. That has a contract value of the futures price times the multiplier, and we have just one contract. So that has a contract value of $730,500. So that's the kind of the value of the portfolio at maturity that will be delivered. The interest rate on margin balances are 2.5%, and the initial margin is 10%. So in other words, you must deposit 10% of that contract value, $73,050, and put that at the exchange, deliver that to the exchange. Sometimes it's called a bond requirement. In other words, you could just simply deliver treasuries equal to $73,050. And if your margin falls to 70% of that, $51,135, you'll get a call from the exchange or the clearinghouse to get your balance back up to $73,050, which means you'll have to make another deposit in that account. And so on period 0, let's go long one S&P futures for September delivery. That futures price on the day I take the position is $29.22. And then let's just say for the 10 weeks till maturity of this contract, these are the prices at the end of each week. And then the contract matures on this date and delivery takes place. So let's calculate the futures price change, simply the new futures price. So it'd be the price next week for that September delivery minus the initial. So the futures price, say, goes down 100 and follows this pattern, eventually winding up at 3,100 above the price in which you're long. We then deposit that 73,050 in our margin account. We will then earn interest on that equal to 1 plus the stated interest rate. And since this is weekly balances or or simulation here or modeling of it, I'll do 1 week of interest. So if nothing happens, I'll have an extra $35 of interest. However, we had a contract or a price change of minus 100 times number of contracts times 250. So actually our margin balance is going to fall by about $25,000 because the futures price fell 100 and we have 250 of a multiplier. So I'm actually down $25,000 after 1 week. And also notice that the margin balance fell to $48,000, which is below the maintenance margin of 51. So really what I need to do is deposit another amount of money to get it back to 73,050. But let's ignore margin calls for now and just see what would happen if there were no margin calls. I need to anchor the interest rate. I need to anchor the number of contracts, and I need to anchor the multiplier. I'm not going to anchor the beginning balance or the change in the futures price. So I'll copy that down. And what you'll see is, again, ignoring any margin balance or margin calls. Here's what happens to my margin balance. Every time the futures price goes up, I'm going to gain some value. Here's the change in the balances. And every time it goes down, I'm going to lose some money. At the end, you'll see that I started with 73,050 as my initial margin. That is my security deposit. At the end, on the maturity date, I had 117,865, and that would be based on that closing price on that third Friday. The difference between where I started and where I ended is 44,815. We can consider that our profit plus interest, or I can just sum up the differences. Now, if this were a forward contract and I went long at 29.22, and the final closing price was 3,100, because again, remember, at the end of a futures contract at maturity, there's a convergence to spot and forward. So if the spot price at maturity is also equal to the final futures price of 3,100, if I just took my final spot price minus the initial futures price times my 250 times the number of contracts, I would have made $44,500 if this were a forward contract. However, I would only had one cash exchange at the maturity of the contract. I wouldn't have any interim mark-to-market or daily P&Ls or daily settlements if this were a forward contract. If this were a forward contract, I simply would receive a check at the end for $44,500. With the futures contract, I'm realizing those profits every single day. And if the profits start going down, I may even get a margin call. But again, we've ignored this. I've highlighted here whenever the margin fell below, or the maintenance margin fell below 70% of the initial margin. One last thing related to the daily settlement process is the futures hedge ratio is less than a forwards hedge ratio due to this daily mark-to-market that magnifies gains by allowing the earning of interest on gains. So we talked about before that the optimal hedge ratio for a forward contract is the beta, if we're doing a cross hedge, that beta is between the underlying asset and the hedge asset, times the spot price of the underlying asset times quantity, divided by the spot price of that hedge asset, divided by, that would be the optimal hedge ratio for a forward contract. For a futures contract, simply take that and divide by 1 plus R to the T. So the optimal hedge ratio for a futures is the optimal hedge ratio for a forward, which is this part here that's circled, over 1 plus R to the T. And that's because, and well, you can see the effect. The effect is you need less futures contracts than you do forward contracts. This is called a tailed position in finance. And the reason why you need a little bit less is any gains that you receive earlier are going to get magnified. You're going to earn interest on them. So you need a little bit less than if this were a forward contract. So in this topic, we calculated for an S&P 500 futures contracts, the margin, initial margin, maintenance margin, margin calls. We calculated the daily settlement, or P&L, and we compared that to a forward contract. The next topic, we're going to talk about cheapest to delivery